Good day, everyone. Thank you for joining us for AfriForesight's webinar on the Southern Africa Commodities Outlook for 2025. My name is Vinesh Chetty. I'm AfriForesight's Head of Research. Unfortunately, our Chief Economist Nathan Musson couldn't make it, but we'll still be covering all of the same topics. For newcomers to this forum, AfriForesight is the largest mining research house in Africa, and we have a multidisciplinary team ranging from economists to engineers. We provide forecasts for Africa's key extracted commodities and the major cost items required for mining and processing commodities. Today, we'll kick off with a brief overview of the global economy, followed by an unpacking of our 2025 forecasts for key energy and industrial commodities. While our time is limited, we aim to deliver as much as possible. For more in-depth insights, we do provide comprehensive reports available to our subscribing clients. For that detailed information, please reach out to Sebastian Naidu, our business executive, or Kelly Marthy, our client servicing manager. The email addresses are on screen now. We will be answering questions live at the end of this presentation. If you'd like to ask a question, please use the Q&A function, which is built into Teams. If you click on the button on the Q&A, which should be on your toolbar if you're using on your computer, click on the Q&A button and type your question, and we'll answer as many of them as we can at the end of the webinar. If you need to leave early, please send an email to Sebastian or Kelly, and we'll email you back with an answer to your question. A recording of this webinar will be placed on our website later this week, and our clients can request a copy if they so need. Thank you again for being with us here today, and let's jump straight in. As I said, we'll be starting off with a global growth outlook, and what you see on screen is the percentage change in the world economy. The bars above zero show the world economy growing, and this negative bar here in 2020, that was the COVID contraction. Now, as you'll see here, that the world economy's growth rate has slowed. We are at a lower growth rate in 2024 than we were before. Now, what's caused this? So we've seen a relatively weak China. I'm sure many of you have seen China's property sector issues. So when one of the world's engines is not running at 100%, that slows the world economy. We've also seen a weak Europe. They've had quite a lot of energy sector struggles, particularly with oil, natural gas coming in from Russia being massively reduced. So Europe's had an energy crisis that's hurt their economy. We've also seen lots of regional conflicts flaring: the Middle East, Ukraine, China, Taiwan, US versus Europe, US versus China, Europe versus China. All of that tends to slow growth. And then just recently with the new US President Donald Trump, he's being a protectionist. He's trying to make the US a bit more of an island as far as goods and services go. And in general, when you curb global trade, that tends to slow the world economy. So that's a big part of how we've gotten to this weak 2024 and expectation of a relatively weak 2025. Now, for some more details on some of these issues, when you look at business and consumer confidence up at the top, these are surveys on how people and businesses feel about the environment, the business environment. You'll see that we are generally weaker now than we were 3 or 4 years ago. So a little bit of concern. And again, that means businesses less willing to invest, people less willing to spend. Then I think a very clear reading for the physical side of the economy here with the manufacturing PMIs. The PMIs are a measure of the industry itself. If the numbers are high, above 50, that shows an expanding manufacturing business in those countries and regions. If it's below 50, it shows contraction. And as you can see here at the end of 2024, most countries' manufacturing was contracting. China in the gray was just above 50. So China was expanding, but very slowly. So again, the world is generally experiencing a manufacturing slowdown. I spoke a little bit about geopolitical conflicts, and I think you see that well in the gold price up on the top left here. Gold price is absolutely shooting the lights out, and that is a sign of people wanting a safe haven asset during times of trouble. Also, we've seen quite a lot of high inflation over the years. That's also something that pushes people towards gold. And then for those of you involved in shipping and logistics, we have seen some supply chain pressure build up again. These high numbers back here in 2021, that was when it was very difficult to ship goods around the world. things have generally improved, but still we are seeing some supply chain pressure even at the end of 2024 and into 2025. Now, what does all of this mean going forward? Well, it's not all doom and gloom. While 2025 is probably going to be a weak growth year, we see things picking up going forward. We've had some interest rate cuts, and we expect some more interest rate cuts into 2025 and maybe even into 2026. And as those interest rates come down, in simple terms, that puts money in people's pockets, that sees people go out and buy more goods and services, and it sees businesses willing to expand. We also see those supply chains recovering, making things a bit easier to trade around the world. And we see a lot of investment in the green transition. Now, we're going to talk quite a lot on the commodity specifics up next, but the important thing here from the global growth is we see the world economy picking up. And as the world economy picks up, that tends to be good for commodities across the board. So as I said, we will do questions and answers. So please click on that Q&A button, type your questions, and we'll get to them at the end. But for now, we're going to get into the commodities themselves, and I'll be starting us off with crude oil. So when it comes to oil, it's worth remembering that oil is used in multiple aspects of the economy. It's not just for cars in the form of petrol. It also goes into other things, and particularly on the diesel side, you've got a lot of exposure into the industrial side of the economy. What does the price of oil have in store for us, though? We expect generally declining oil prices going forward. Now, what's pushing these oil prices down? Mainly, this is increasing supply. We have the OPEC Plus group, that is the group led by Saudi Arabia and Russia. And we know that they're going to put more oil onto the market in 2025. As they put more oil on the market, that pushes down on prices. We also have a new US president who is more pro-oil, who has more policies that are likely to keep oil producers going in the US. So that again keeps supply high. And on the demand side, we see only slow growth in oil demand. We see a shift towards electric vehicles, particularly outside of the United States, but in the developed world. And we see rising efficiencies in the cars that use petrol. And we continue to see a shift to cleaner alternative fuels. So all of that combines into declining prices of oil, which in turn puts a bit of downward pressure on bulk commodities. So a bulk commodity that's quite important for South Africa is coal. But while coal brings in a lot of revenue for South Africa, I do like to put things into context. So what you see on screen is the world's thermal coal exports by country in 2024. And you'll see here that while coal is very important for South African mining economy, on the global scale, we are not the biggest player, 5% of global exports. You'll see a little bit later when we look at chrome and manganese and PGMs, South Africa is a big or biggest player. When it comes to coal, we are not the biggest player. Now, why is this important? When South Africa has port and rail problems, as we have had in recent years, in this situation, it basically becomes a signal to our competitors in Australia and Indonesia to ramp up production so that they can take market share. Now, while Australia tends to produce a lot of high energy coal, good quality, low impurity coal, Indonesia, while it is the largest exporter of coal, it tends to export a lot of low energy coal, high impurity, low energy coal. So Indonesia and Australia are both competitors for South Africa in Asia, but Australia tends to sell more high quality product and Indonesia more low quality product. When we look at who buys coal in the world, it is mainly Asia. China and India are the two largest importers of coal. That is despite also being the two largest producers of coal. So China and India produce the most coal, but they also import the most coal, showing you that they consume the most coal. And again, when you look at who these buyers are around the world, they are mainly in Asia. So South Africa is well placed to supply coal to Asia, particularly with our eastern coast port. Richards Bay is well set to supply to Asia, particularly India, which is South Africa's main customer for coal. When we focus in on India itself, few things to look at. Up on the left, we've got India's thermal coal production. That's its domestic supply. And you'll see that this domestic production has been rising, and we expect that it continues to rise. And if you've been following India's coal market for a while and you've been listening to their ministers, they have said that India wants to become self-sufficient, that India wants to end imports of coal. But despite the fact that they've got this rising domestic production, they also have rising imports of coal. And that shows you that their consumption of coal is rising faster than their domestic production. Now, where is all of this coal going in India? A lot of it is going into coal-fired power stations. What you see down here at the bottom in orange, this is the new capacity coming online in India each year. So you will see that India built a lot of power stations in the mid-2010s, and 2024 was a relatively strong year, but there's not that many new coal-fired power stations coming online in India going forward. But we are still optimistic on India's coal demand. Now, it's worth remembering that these power stations that were built in the last 10 years or so are probably going to operate into the 2040s, 2050s, maybe even into the 2060s. And also, with the President Trump at the helm in the near term, perhaps the US will not be as environmentally focused as the European Union. So we're less likely to see the US with a carbon border tax like the Europeans. So again, that gives more impetus for places like India, Indonesia, South Africa to burn coal going forward. So we are still positive on South Africa's coal exports to India. Even if India's domestic production keeps rising, it's worth remembering that South African coal often has an advantage on energy and lack of impurities compared to Indian coal. Also, South African coal is not only used in India's coal-fired power stations, India also uses South African coal to make cement and in steel making. While South Africa's coal is mainly thermal, India does use South African thermal coal in a process called direct reduction of iron that gives South African coal exposure to the steel making business and the cement making business and the electricity business. So again, lots of demand for South African coal in India. When you look at who makes or who mines the coal in South Africa, we have 5 big players who produce 68% of the coal. While some of these names may be new to some of you, we've basically seen an exit of most internationals, the Anglo-Americans, BHPs, and South 32s. And now we have mainly South African companies, plus the big international in Glencore, which, while it flirted with exiting coal mining, has now decided to stay. So these are your big producers of coal in the country. And from what we've seen, they are planning to stick it out in coal mining. As we'll see a little bit later, the profits are still there. When we look at where coal mine in South Africa is sold, most of it goes to Eskom. You see at the bottom here, Sasol uses a lot of the coal themselves to make chemicals and synthetic fuels. We have a small domestic usage for other industries, and then quite a lot of exports up at the top here. Now, while exports are not the biggest in terms of volume, they do bring in the good revenue. Export coal brings in much more money than domestic sales. So we'll take a little bit of a look at the export market next. What you see on screen now is South Africa's exports of coal by the country that we send them through. And you'll see a few things here. India is our main customer. This is where we sell most of our coal to. Europe in the purple is generally fading out. Europe is now using less energy than it did before 2022, and it's got more gas in now than it used to have. So that's shifting them away from thermal coal. And China in the red is almost a non-entity for South Africa. You'll also see here the green Mozambique. Now, for most of that coal, that is South African coal that is being exported to Mozambique for re-export, particularly the ports of Maputo and Matola in southern Mozambique. That's where a lot of South African coal is going through to be exported to the world. Why is South Africa choosing to do that? Well, that's mainly on Transnet issues. Rail and port issues make it difficult for South African coal miners to export through Richards Bay. So that means more South African coal going via Mozambique. And you'll see some of that here with the top line. This is the overall South African coal export volume, that there was generally a decline from about 2017 into 2023 and 2024. So again, as those South African coal miners needed to find alternative routes, they started using Mozambique. But there is some good news. As we got to the end of 2024, we started to see that perhaps Transnet is making some improvements. The November 2024 export number was actually pretty strong, just about on target. So maybe Transnet has started to turn a corner. Maybe things are looking up because there certainly is demand for South African coal, particularly out in Asia. So when we look at those Transnet plans, they do expect to increase their coal rail volumes into 2025. Yes, we do still have problems. The private operator plans, the third-party access remains stalled. But as I said, at the end of 2024, maybe we have turned a corner and we can get those rail volumes up, which will allow South Africa to mine more coal because certainly there is a demand in the world. What does all of this mean for prices? Broadly, we expect thermal coal prices to move sideways, to stay fairly steady around their current prices. What we see on screen is the RB1 price. That's the benchmark export price. Now we've got lower oil prices that helps to bring these, keeps these prices low. But as I said, we have strong coal usage in Asia. We've seen right now India is burning a lot of coal, high demand, and again, we're seeing rising demand in the rest of Asia. So that can again help keep these prices quite steady, even in a world that is shifting to cleaner energy sources, even in a world that's trying to decarbonize. We do see particularly Asia going to be burning a lot of coal for a long time to come. When you look at the margin, that is a level of profitability, you'll see that South African coal miners are making about 15 to 20% at the EBITDA level. And from what we can see, that's enough money to keep those who are in coal mining staying in the game. It's not enough to really attract a lot of new investment. That's why you're not seeing many new coal mines being built. But for those big five who are in coal and some of our smaller South African coal miners who've come into the game, we think they'll probably stay in for a while. So that's it on the energy side of things. Please, again, use that Q&A button to type your questions if you have any. But for now, I'll hand you over to Devin.
Thanks, Vinesh. So I'll be giving a brief overview of the iron ore, manganese, and chrome markets, just discussing where we see price movement going forward. But before I jump into the commodities themselves, just want to provide some context. When taking a look at the leading producers of crude steel, which uses iron ore and manganese in its production processes, and the leading producers in stainless steel industry, which require our chrome ore and ferrochrome, China dominates these markets and therefore drives demand for these raw materials. When taking a look at the global crude steel production, China continued to be hard hit by the indebted property sector, which curbed their demand in 2024. This has been a persistent issue for many years. Major property developers like Evergrande and Country Garden faced threats of liquidation, where Evergrande eventually was liquidated early last year, not being able to establish a viable debt restructuring plan. As a result, steel producers were forced to pull back on their production in line with the weak demand and profitability. However, some positivity did come through this week after Country Garden resumed resumed their share trade after a 9-month suspension as they attempt to restructure some of their debt. But we still expect these property sector concerns to weigh on crude steel production for 2025. Steel production growth should mainly be driven by capacity expansions in India, who is also a significant importer of manganese ore from South Africa. We can also see this weakness when looking at China's stainless steel production in 2024, which will require our chrome ore and ferrochrome. Alongside the China demand concerns, demand was also impacted by the high inflationary environment and related interest rates, which curbed some of the consumer demand. Although there was a significant ramp up in in stainless steel production in the first half of last year, the weak demand made it difficult to draw down on high inventory levels at those steel mills, forcing some producers to reduce or suspend their operations towards the end of the year. We expect some stabilization and recovery to China's economy in 2025 after a series of stimulus measures that were announced last year, which should support both the property sector and demand from consumers, allowing steel production to gradually ramp up. But in general, prices for the steel and stainless steel input commodities are closely related to the economic and industrial activity in China in terms of demand. So when taking a look at China's annual import trends for iron ore, manganese ore, chrome ore, and ferrochrome, In 2023 and 2024, we did see strong increases in imports for all commodities except manganese in 2024, as China's industrial activity picked up um, following the COVID constraints in 2022. This is a positive for South Africa, with China being the largest buyer of these commodities. Manganese ore, on the other hand, um, was impacted by reduced shipments from Australia and Gabon. Supply from Australia was significantly curbed after a cyclone impacted their export terminal and South32's operations. And this provided, although it reduced the available manganese ore supply, it did provide a significant opportunity for South Africa. So when looking at South Africa's exports, there was a significant pickup in manganese exports since 2023, um, which was mainly supported by improvements to logistics, to the logistics infrastructure, where this trend continued through to 2024, with producers taking advantage of those higher manganese ore prices in the beginning of the year as a result of Australia's supply constraints. South Africa actually achieved record exports in May 2024, but this increased supply did place pressure on manganese ore prices, prompting South African producers like South32, UMK, and Jupiter to reduce their exports towards the end of the year. On the other hand, iron ore exports have remained quite constrained due to the ongoing port and rail problems. Anglo American's Kumba is South Africa's largest iron ore exporter, who was forced to cut back their production since 2022 due to excessive stockpiling at the mine, as a result of the rail and port inefficiencies, which stopped them from getting their products out into the market. And Kumba actually plans to maintain their production until at steady levels until the end of 2026. But we should see a recovery with Transnet's plans to increase the Sishen-Saldanha railway line and the Saldanha Bay port capacity. But this is in a few years' time. We unfortunately don't see significant improvements coming through this year. Looking at the stainless steel input commodities, we did see a significant pickup in chrome ore and ferrochrome exports in 2023 with the recovery in demand from China, which was further supported by South Africa's partnership with Mozambique, allowing easier access through Mozambique's Maputo port. However, elevated electricity costs have continued to pressure local ferrochrome operations, forcing smelters to remain on care and maintenance. And this curbed South Africa's ferrochrome supply and exports in 2024, resulting in higher volumes of unprocessed, of chrome concentrate exports, which takes up more of our rail capacity. However, towards the end of 2023, NERSA did approve a negotiated price agreement for some of the ferrochrome smelter operations operated by the Glencore Morafe joint venture and Samancor Chrome, which should provide some electricity tariff relief for these producers and somewhat improve domestic production. But moving on to our outlook for 2025. We're positive in the demand for both the crude steel and stainless steel. On the crude steel side, when looking at the iron ore and manganese price at the top of the slide, we expect large-scale multinational infrastructure projects to gain traction, while the recent stimulus in China should provide some stability to their property sector, boosting demand for both these commodities and placing upward pressure on prices. For stainless steel industry, looking at the chrome ore and ferrochrome forecast at the bottom of the slide, we expect the construction and infrastructure projects to also support demand for the industry, but we're also positive on some recovery to the automotive and hospitality industries as global growth picks up. So with these expectations of demand growth, prices are expected to rise over 2025. However, iron ore doesn't quite fit this trend. Although demand growth is expected, iron ore prices are expected to generally decline. And this is mainly on expected supply growth from some of our major supply regions like Australia and Brazil, which should place downward pressure on iron ore prices. With iron ore EBITDA margins expected to average around 40% over 2025, there is still very good money to be made, and this is incentivizing these mines to ramp up, especially in these major global producing regions. That generally concludes the discussion on the steel and stainless steel input commodities. I'll hand over to Kirti now for an overview of other industrial metals.
Copper demand, this is expected to remain positive throughout the period. We expect demand from electrification to rise as emerging economies expand power grids and telecommunications networks, alongside advanced economies investing in electrical infrastructure and building artificial intelligence systems and data centers. The construction of renewable energy plants should boost demand as many countries aim to meet carbon emission goals. The gradually rising market share of EVs should increase copper demand alongside the expansion of the charging network. However, demand growth should be capped somewhat by increasing substitution with aluminium in applications where wiring is publicly accessible and vulnerable to theft. But copper still has better conductivity compared to aluminium and is still preferred in most applications. China is the largest refiner of copper. Refined copper production is expected to increase in 2025. Smelters plan to use secondary copper supplies such as scrap and blister copper and widening their blending of copper concentrates to increase their refined production. However, copper concentrate treatment and refining charges paid by mining companies to smelters are expected to remain low in 2025, as China has an excess of refining capacity compared to the supply of copper concentrates and ores. So about 35% of mine supply comes from South America, where production has been rising, but increases are expected to be capped by supply constraints such as frequent community protests, water scarcity, and declining ore grades, as well as aging mine infrastructure. We expect production increases from the DRC and Zambia due to the Central African Copper Belt. In the DRC, production should rise as existing projects expand and new projects start up alongside the government's increasing efforts to attract investments into copper mining. However, copper mining in the DRC does face some constraints, such as inadequate transport infrastructure and logistical challenges, as well as illegal mining and the use of child labor, which should discourage some foreign investment. Zambia aims to increase their copper production, and this target is ambitious and requires all planned expansions and new developments to come online without any delays or cancellations. The government also plans to introduce reforms to support its production and plans to diversify energy sources by investing in renewable energy. And that's to ensure sufficient electricity for mining. In 2024, we saw that some copper mines had to reduce their production due to a hydropower shortage. However, the Zambian government does plan to own up to a 30% stake in new copper mines, which should slow down their foreign investments into new operations. So prices should increase on the improving demand for electricity, renewable energies, and as EVs gain market share, despite some slow supply growth from South America and Africa. However, near-term prices should be capped somewhat by weaker consumer demand amid those still elevated interest rates in some regions. So the EV transition boosts demand for our battery metals, which are lithium and cobalt. The EV market share is expected to gradually increase as most governments aim to reduce carbon emissions. Hybrid vehicle sales should also grow moderately over 2025, especially in regions where charging infrastructure availability is a concern. However, ICE vehicle sales should also be sustained over the period, putting downwards pressure on demand as some countries soften their EV sales targets and remove subsidies. So EVs and hybrid sales are expected to gradually rise over 2025, but sales should remain somewhat constrained amid those elevated interest rates initially. So lithium demand should face downwards pressure with some substitution from sodium-ion batteries, mainly in low-range vehicles by Chinese automakers. But lithium batteries should remain the preferred choice by consumers due to this higher driving range. Cobalt demand should also face downwards pressure as some battery makers aim to replace cobalt with more ethically and environmentally friendly alternatives. Some major vehicle producers such as Tesla and Toyota and Ford started using LFP batteries, which do not contain cobalt in some EV models to reduce their costs. However, cobalt-containing batteries should remain the dominant market share into 2025 due to these higher driving ranges. Despite the increasing demand in 2025, prices should remain relatively weak due to the mine supply surplus for both lithium and cobalt. However, the surplus should decrease compared to our 2024 levels as some lithium miners deferred investments, cut jobs, and suspended expansion plans amid low prices. And some cobalt refiners like Jervois Global in the US also followed suit amid weak prices. However, overall mine supply is still expected to increase as cobalt production should rise as copper mining is expected to increase, incentivized by the high copper demand and the high copper prices, mainly in the DRC and Zambia. Lithium production should increase as Pilbara Minerals aims to ramp up the Pilgangoora operations in Australia and new projects come online and ramp up in Ghana, Zimbabwe, and Mali. So lithium and cobalt prices should trend downwards over the first half of 2025 amid the supply surplus and the weaker than expected consumer demand initially. Thereafter, prices should rise on gradually improving EV demand and as governments and automakers incentivize EV sales to meet their emissions targets. The sustained internal combustion engine vehicle demand should place some downwards pressure on battery material prices. But the sustained use of ICE vehicles should increase demand for PGMs, where PGMs are used as autocatalysts to reduce harmful emissions. Due to tightening emission standards, we expect higher PGM loadings into vehicle autocatalysts. Plug-in hybrids can require up to 15% more PGMs than ICEs. And some automakers are also testing biofuel and synthetic fuel use in their engines, which should still require autocatalysts use. So, however, we do expect that initial weakness due to the elevated interest rates. We see that industrial demand for the PGMs is also expected to remain weak amid fewer glass-making capacity expansions, where PGMs are used as catalysts as well. Platinum demand from the hydrogen economy is currently rising off a small base, where we expect hydrogen use to increase amid the preference for cleaner fuels and greener feedstocks. However, the demand should be capped initially as hydrogen logistics and storage infrastructure still needs development. Hydrogen has to be stored at low temperatures and high pressures or converted into another form like ammonia or methanol for transport, which are all cost intensive. But many governments, especially in Europe and Asia, are encouraging hydrogen production, especially from renewable sources, which requires PGM catalysts. And many of these projects, although in development, are only expected to come online in the medium to long term. However, due to the high capital costs and the weaker than expected demand for hydrogen initially, we see some producers such as BP canceling some early stage projects as part of cost saving measures. Demand should also rise later on as chemical production increases where hydrogen is used as a clean feedstock. and for blending into natural gas pipelines to reduce carbon emissions. Looking at our PGM supply, South Africa is a major producer, producing about 70% of platinum and over 80% of rhodium. South Africa produces 38% of palladium, and we're the second largest producer, with Russia being the largest, with 41% of global supply. South Africa mine supply should remain constrained in 2025 as major producers deferred investments and put expansion plans on hold to cut costs amid lower profitability. In the first half of 2024, operational profitability margins were still positive for most miners, which indicates that the cost-cutting measures seem to be working, as some prices expect to remain stable in 2025, and PGM prices are expected to increase in 2025. We expect the profitability levels to also remain stable. But despite this operational profitability, PGM miners have relatively high capital costs, which should deter new investments in greenfield PGM mine developments. But brownfield projects, which are currently under development, are expected to reach completion and start production, such as Basisway's Bakubang mine and the Ivan Platreef mine. So South Africa's refined supply should remain stable, as many miners are refining PGMs out of existing ore stockpiles, and the absence of load shedding should further encourage refining. Russia's supply should increase as Nornickel completed their long-delayed smelter maintenance and aims to ramp up production. The US supply should decline as Sibanye-Stillwater reduced their production guidance at the Stillwater mine by about 44% and put 1 out of 2 shafts on care and maintenance. The platinum prices should increase amid sustained ICE and hybrid vehicle demand, and later in the period by growth in the hydrogen economy. Palladium prices should remain relatively elevated, initially due to the US supply concerns, but then should decline over the period amid EVs slowly gaining market share. However, those tightening emission standards and the growing hybrid demand should cap price declines. Rhodium prices should increase as it's preferred as an autocatalyst because it's more effective in reducing emissions compared to platinum and palladium. We also expect prices to rise amid South African supply constraints, and the growing demand for hybrids and ICEs should put upwards pressure on these prices. So that concludes the formal part of our presentation. Let us move on to the question and answer session.
Thank you. I do see we have quite a few questions already. Maybe if Devin, if you and I can tackle this first one together. So there's a question around which port is the main manganese export point from South Africa?
Yeah, so the main port, I'm not sure. I've got a figure that I could maybe show. So the main export terminal for manganese is in Port Elizabeth, but also significant volumes come through Saldanha Bay. We have seen quite a significant ramp up through that Saldanha Bay port.
Thanks a lot. And then, yeah, for the rest of that question, I mean, if we go through the bulks, iron ore, Devin, where do we send most of that?
Iron ore would be so also Saldanha Bay.
So yeah, so most manganese through Port Elizabeth, most iron ore through Saldanha. As far as coal goes, the vast majority goes through Richards Bay, but we are seeing quite a lot through Maputo Matola in Mozambique. And chrome, I think something similar also. Richards Bay and Mozambique are our two main export points.
That's correct, yeah.
Yeah. And then another one for you, Devin. So there's this talk that maybe Chinese steel production has peaked. There's obviously been a lot of restrictions lately. Maybe talk to us. Was 2022 maybe the high point? Are we coming down a bit?
Yeah, so China's steel production has been in decline for a few years. Initially, their main target was to reduce some of their polluting capacity, where China would ramp down their production at the end of the year to try to curb that pollution. However, some of the weak demand because the property sector came through last year, and they previously had policies which they didn't implement last year because there just wasn't enough demand to draw or to motivate additional production. So generally, we generally were at a peak, but I think we may only see a pick up once China starts converting to more sustainable methods, like using electric arc furnaces versus the polluting blast furnace operations.
Well, very interesting. And I see we have quite a few more questions. Again, please, if anyone has questions, please click on the Q&A and type them. Kirti, one for you. So there's a question here around Sibanye putting some shafts on care and maintenance. Do we know which ones those are?
Yes. So at the Stillwater mine in Montana in the USA, they suspended mining operations at the Stillwater West mine, and they're deferring spending at their Stillwater East Boulder mine. So that's one out of their two shafts that's on care and maintenance, and the other shaft has just reduced their production.
Okay. Then maybe, Kirti, while we're still with questions linked to your side. So there's a question around lithium demand and is maybe, the new US look, we've said President Trump is maybe less environmental. Could that US shift maybe dent lithium demand a little bit? Maybe the US leans towards ICEs?
Yes. So if Trump does go ahead with removing the electric vehicle subsidies, then we should see a decline in the demand for lithium because we'll expect the consumers to stick to their to buying their ICEs or maybe shift to hybrid vehicles instead of fully battery electric vehicles. And hybrid vehicles, even though they use lithium, they use a much less amount of lithium compared to your fully battery electric vehicles.
True. And then maybe just on the EVs as well, there's a question here around the South African EV market. Are we seeing much of an increase in South African EV sales?
So we have seen EV sales and more particularly hybrid vehicle sales rise, although that's up a very, very low base and they're rising very slowly as well. South Africa itself is not really, the government's not really pushing for electric vehicles for their consumers to adopt electric vehicles. We don't have an ICE ban, we don't have EV subsidies. So yeah, South Africa is not the market that's pushing for EVs, although they are available for the consumers that prefer them.
Okay, then maybe another two-parter here for Devon. If we start with the international side, so there's a question around, do we expect the steel industry to be subdued? And does that have an impact on our iron ore outlook?
It's referring to the domestic side, Vinesh.
Oh, sorry. If the question is entirely on the domestic side, start us off with the metal side, then go ahead. Sorry about that.
Oh, sure.
Yeah.
Yeah, so beyond the weakness, I think in China, South Africa's economy is quite constrained. We've back in November already, ArcelorMittal reported talks of winding down their longs operations, but they were able to sustain their operations through last year with some agreements made with government to improve some rail access, some logistics. But South African producers are continually competing with exports from China. China's been ramping up their exports to try and make up for the weaker domestic demand, and that's impacted domestic producers. ArcelorMittal actually has announced that they're going to wind down their operations by the end of shut down their operations by the end of Jan and close their long business completely in the first quarter. So that is weak iron ore demand domestically.
Unfortunately, very true. Yes, but we do keep track on the domestic market. So we have quite a few. We still have questions to get through, but while we have the slide up on screen, some of you may be seeing our social media handles and presence. So of course we have the AfriForesight website, but AfriForesight also has a presence on LinkedIn and X or Twitter. So our handles are up on screen. We do post on there regularly. So please, if you'd like to keep track, if you'd like to keep up with what we do, we tend to post things up there each day to keep the market abreast of what's happening in the commodity world. So if we get onto some more questions, maybe Kirsty, for you on the PGM hydrogen side. So there's a question about the EU doing a big investment in hydrogen. Is this maybe a push for PGMs? And then also maybe is there any potential for Sasol on the hydrogen side?
Yes. So the EU investing into green hydrogen is a positive for PGM demand. Or PGMs are used as a catalyst in these electrolyzers that produce green hydrogen. So we should see that push up on PGM demand, especially from South Africa, where because the EU doesn't mine their own PGMs and they tend to import a lot of PGMs from South Africa at the moment for their automakers. And we should see those export values rising as their hydrogen economy develops as well. And for Sasol in South Africa, so Sasol did start production of green hydrogen at mid 2024. And we do see them expect to ramp up that production. They're currently producing green hydrogen using wind and solar power. And we should see them ramp up their production.
No, all good. Then I think we have quite a few questions that sort of tie together, and Kirsty touched on it with this US. So there's a lot of questions around the new US president. I did mention, he's trying to be more protectionist. So there's quite a few questions here around, what impact can these tariffs have? So I think let's start with where Kirsty was with the PGM. So the US can place an import tariff, and if President Trump goes to the fullest extent he talked about with tariffing everything, then the US probably has some shortages on quite a lot of materials. And I think, Kirti, you've already said PGMs, the US uses far more than they can mine inside the country, correct?
Yes.
And I think most of those EV materials as well, they'd probably be quite short on.
Yeah, so they're planning on opening up lithium mines, but they're not operational yet. So currently almost all the lithium they get is imported into the US.
Fair enough. And then Devon, I think manganese is a bit of a similar situation for them.
Yes, that's correct.
Yeah. So the US, they can try to wall themselves off and you'll see multiple impacts. But I think because there are questions around, is this an opportunity for South Africa? I think South African PGMs would simply be needed in the US. Things like manganese would probably be needed. There is a question around what impact does the president have on oil? So here's where it's a bit more nuanced because the USA already produces more oil than consumes. The US is now a net oil exporter some of the time, and certainly a net petroleum product exporter. So when you account for diesel and petrol and the like. However, it's not as simple, and I'm sure there's lots of engineers in the audience. It's not as simple as saying, a US barrel of oil is equal to a Saudi barrel of oil. There are different grades of oils. There are different types of oil. So while the US on pure numbers of barrels of oil probably has enough, a lot of their refineries are built around other types of oil. That's why the US still brings in oil from Venezuela, even though it has so many restrictions on the country. It's why a lot of refineries in the northern parts of the US are built around Canadian oil. So those sanctions could make it very difficult for some US refineries to export their oil. Also, you have the secondary impact. So if Saudi Arabia sends less oil to the US, if Venezuela can't sell their oil to the US, they're probably still going to try to sell that elsewhere. So it could create high prices in the US, low prices elsewhere. So those are those interesting secondary impacts. And it's worth remembering with the President Trump, he hasn't articulated all of his policies perfectly. He's changed his mind. He's gone back and forth on a lot of things. So it's very hard to know for sure. But in general, he seems to be wanting to be more protectionist on the US. And in the last month or so, we've seen him walk back a lot of the plans. So it wasn't a straight tariff on every country on day one. Now it's we'll probably tariff Mexico, Canada, China from February. Maybe we hit the EU, and maybe it's going to be more targeted on what the Americans consider national security goods. So are there opportunities? Absolutely. I think with the cars, especially if the US is going to be trying to build cars in America, they're going to, and they're not doing EVs, they're probably going to have to be buying South African PGMs because South Africa and Russia are your two big PGM sources. All right. Then I see there is a question around the gold outlook. In simple terms, South Africa, or sorry, the gold outlook for South Africa. So South Africa, unfortunately, not going to be producing much more gold going forward. Our mines are very expensive to mine at compared to the rest of the world. But high gold prices, we see gold relatively high still, maybe a bit of a pullback from this 2,700 level, but generally high gold prices. But for South Africa, unfortunately, digging out gold 2, 3, 4 kilometers underground, very difficult, very expensive. It's easier and cheaper to mine that gold in places like Ghana and Australia and Papua New Guinea. And that's why we've seen a lot of South African headquartered companies looking elsewhere. Then we have an interesting question here around which are the main ports for exporting South African commodities. We probably have to look into the specific volumes, but I would think it would be Saldanha Bay and Richards Bay as your two big commodity port exporters. As Devin has said, most iron ore goes via Saldanha Bay. Richards Bay takes most of our coal and also a significant amount of our chrome. So those would probably be your two biggest port exports. Do we foresee private sector participation? That is the plan. It is worth noting that has been the plan for decades. Private rail access, a move to we already do have some private operations at South African public ports. Yes, we do think that the government is still moving that way, even if the government moves slowly. What impact can that have on volumes? We could see them rising. We have seen this in Mozambique. We've seen what a private-public partnership can do in southern Mozambique, and we've seen volumes rising through Mozambican ports. That's why more and more South African coal is going that way. That's why the majority of South African chrome ore is now actually exported through Mozambique instead of through Richards Bay. So yes, we do see, even if it's slow progress, more movement towards private participation, and we think that can be positive for volumes. All right. Please do continue typing if you have any questions or comments. I do see one here, Kirsty, about lithium project by Sibanye. Do you maybe know anything about the Rhyolite Ridge project?
Yeah, so the Rhyolite Ridge is still under development. I don't think they've started construction yet because they are still applying for their permits. Last year in, I think, September, Sibanye-Stillwater was considering investing more money into the project. And in about October, they received one of their permits from the government to try and push this project forward. However, they have been having some legal and environmental problems regarding endangered plants on the project site. So that whole project has been vastly delayed due to those environmental concerns, but they are planning to push it forward and start production by the end of this decade. But yeah.
So yeah, thanks, Kirsty. And again, for those of you who are new to our forum, who aren't clients, this is the kind of information we regularly provide in our reports. And again, you'd obviously have access to our staff if you do subscribe. So please, do reach out to Sebastian and Kelly if you are interested for more on these topics. Then I do see a question around India and coal. So I think this is a great question. Can we see increased coal exports to India on the back of their rising GDP? The answer there is yes. India is becoming, if not is already, one of the growth engines of the world. In the next decade, India, China, and the USA are probably going to be the three countries that add the most to global GDP. And yes, you are right. As India's GDP picks up, as I said, with the world, it's more of everything. Yes, as India's GDP picks up, that's more Indian demand for steel, more Indian demand for cement, more Indian demand for electricity, all of those things. So yes, we've had some lean years, and yes, India is building up its domestic mining, it's building up its inventories, but as India's demand for coal rises, I would see increased demand for South African coal. Again, we talked a little bit about the EU doing those border taxes. South African coal is less polluting than a lot of Indian domestic coal. South African coal is certainly less polluting than your average Indonesian export. So yes, we can see rising demand in India for South African coal. And even if you look simply inside of India, as GDP rises, as people get more money, as living standards rise, that's more people in India using electricity, that will again push demand for South African coal. All right. So then I do see one around Mozambique. Obviously, with the current issues, there's questions around, can they still be a reliable partner? Again, this is where I think AfriForesight's Africa focus can be very useful. It is a difficult time. It is in a lot of flux right now. So South Africa needs those southern Mozambique ports. Maputo and Matola we use a lot, and the rest of Africa relies on other ports in Mozambique as well. So, is it always going to be a guarantee that the Lubombo border post is going to be open? No. We've seen the difficulties there. But we see lots of difficulties in Africa. And again, for those of you who are our clients, at the bottom of the Monday morning, we do lots of infrastructure stories, which roads are closed, which railways are on maintenance. So Africa can be difficult. But as it stands, with the port and rail problems, particularly at Richards Bay, South Africa is probably going to keep needing to use those ports in southern Mozambique. And again, it's not just commodities. South Africa as a country has lots of business interests in Mozambique as well. Lots of South African companies operate over there. So a stable Mozambique would certainly be good for South Africa as well. All right. If there are any other questions, please do type them now. But as I said, if you'd like to follow us in more general terms, please do join us on LinkedIn, follow us on Twitter, X, and the like. We do try to post interesting things that we think our clients and non-clients would or should be catching up on and finding interesting, mainly on commodities, but we also do look at the world economy as a whole. I do see a few more questions coming through here. So particularly on West Africa, we have a question here around Mali. So these are very interesting ones because you do see that particularly in West Africa, unfortunately, we've had quite a few coups over the last few years. So Mali, lots of opportunity, particularly in the gold sector. Similar to what I said around Ghana, you've got cheap, much cheaper to mine there than in South Africa. But again, when you're dealing with West Africa, we've seen the issues around military governments, presidents being overthrown, governments that decide to take control of assets. We've seen lots of mining companies, unfortunately, in Niger and all across West Africa, having assets seized and permits revoked and the like. So is there potential? Absolutely. But very big risks in West Africa. But again, this is why AfriForesight reports across sub-Saharan Africa. While today we focused on Southern Africa, in our report writing, we do look further north as well. And then maybe just a last one before we'll close off here. There's a question around sustainability of Chinese producers in Africa. So I think there's two parts to that. If you're talking sustainability in an environmental sense, Africa, maybe Kirsty could talk to, often has a slightly lower environmental standards. Maybe Kirsty, have we seen any issues around Chinese companies in Africa with environmental issues?
So like you mentioned, most of these countries have lower carbon emission standards, lower water standards. We haven't seen much in the way of sustainable developments in recent, I would say, over the course of last year. So yeah.
But then if the other side of the question is, do we continue to see Chinese companies investing in West Africa? The answer is probably yes. There's a lot of minerals that China needs. And they've shown a willingness to invest in these countries. So I think that's where we'll leave it for today. I hope everyone has enjoyed the presentation. As I said earlier, we'll put a copy of the presentation up on our website a little bit later for you later this week. And if you're a client, please do ask if you'd like a copy. Again, follow us on our social media. we post there. And thank you so much, everyone, for your time from the AfriForesight team. Have a great day further. Thank you and goodbye.